All right, we're live. I'm gonna give everyone just a couple seconds to get joined in here. Put a notification in the Discord really quickly before we jump into this for our weekly trade ideas. The first time we're gonna be streaming them as opposed to me just kind of blindly sending out an email at the end of the night tonight. So at any point during this, if you guys have any questions or any input that you want to add, just feel free to throw something in the chat, and I'll happily address anything that you guys throw in there. And hopefully this is more of a collaborative group setting for this as opposed to me just kind of sitting by myself and putting this newsletter together alone. All right, so while I'm going through and doing this, I'm gonna have I'm streaming on one screen, and then the screen next to it, I'm gonna have the email newsletter up. So I'll kind of be creating it as we go through this. So if at any point I'm not really doing anything on the screen over here, you'll hear me typing on the newsletter itself. So hopefully the goal by the end of this is that I'll have this email newsletter complete. Everyone who's been tuned in and watching this, or if you're watching this on YouTube afterwards, once we've recorded this and uploaded it, you'll have some context to go along with what we put in the newsletter. So it's a little bit more in-depth and detailed than simply just kind of reading through an email. So hopefully that will be helpful to all you guys. All right, so I guess we're just going to kind of chronologically move through what we typically have here on the newsletter. We start off at the top talking about our past week. So let me pull up the weekly profit tracker spreadsheet that we've got over here. Give me 1 second. Boom, throw that on the main screen. Obviously, for those of you that have been following along with us and following along with the market, last week was a rough week because SPY took a pretty big dip. We're just going to run through our plays real quick and kind of recap how those went for us. We could unhighlight all these cells right here. UWMC off the bat, that one started at 831, dropped to 757. Obviously not great. You never like to lose pretty much 10% on a stock in a week, especially one that we had up in the $12 and $13 range at one point. So that's kind of a tough one, but one of those at the same time, like we mentioned in our previous YouTube videos, was something that we're confident to hold long term. So I don't think that's going to be too big of an issue going forward. So we'll just keep holding on. Our biggest concern right now is with these 7.5 strike puts that we're holding. As long as it can hold above there for the next few weeks, we'll collect that 42 cents, hopefully sell another set of those, and just kind of keep the ball moving on that one and get our basis as low as possible. When we go over to the breakout tab that we have, our break-even price is 836. So, I mean, obviously not great when it's trading at 757. The good news is that it did jump up after market on Friday. We can take a look at that really quickly. So it got up to about 776, and I think that was on news that it was going to be added to the Russell 1000 index. Where are we? Perfect. See if we could find something on that. Doesn't look like anything on Google, but if we go to Twitter, there's typically, funny enough, a lot of pretty good investing information on Twitter. So I think this is when I first heard about this, when I was looking up. Yeah. So we've got this right here with the link to the Russell 1000 website where they have the new additions, and you could see that effective March 22nd. So the good news for us is that when something gets added to an index, what happens is that all the indexes, or I guess all the ETFs that track that index, are forced to purchase it. So on March 22nd, between now and then, they're all going to have to buy up a pretty good bit of UWMC so that their ETF represents the Russell 1000. Now, it's not going to be anything groundbreaking like when people were talking about how Tesla was added to the S&P 500. It's not going to be anything that crazy, but it is definitely a little bit of a short-term catalyst and something I think that should help us definitely not negative, but something that I think is a little bit of good positive news in what's otherwise been a pretty tough go the last few weeks on this one. Additionally, we've got that dividend. If we pull this back up, the dividend's going to be not paid out, excuse me, but the dividend will be given to shareholders of record on March 9th, 2021, and I believe paid out in April. So as long as we're holding this on March 9th, which we will be, since the stocks that the options that we've sold expire March 19th, we're going to be holding those shares until then and get that dividend, which is a dollar for dollar reduction of our cost basis, and something, it's just another tool that we use along with these options to keep driving that basis down and keep it moving. But getting back to the profit, let's see, where was I keep hitting the wrong window. I need to close these out. Okay, back to where we were, going back through our weekly recap. Next one we had was VGAC. That one also took a pretty significant dip, and was something that, if we look up here a week ago, we were trying to just, let's see, I think 2.7 is when we started this play, maybe. Not positive, but this was one a week ago. We were trying to just scalp really quickly and sell at 15 call and get it called away. And that obviously didn't happen, so we're stuck with it for a little bit. But another one, I think if we go to our breakout tab, break-even price is 13. Obviously not ideal when it's at 11.39, but hopefully the market will rebound. We can get a spike back up near those break-even prices and keep it moving. Next thing we had was Psth, and that was another one that we're pretty confident about long-term. A lot of these SPACs we've talked about, the way that they're designed and set up, there isn't really a big incentive for the SPAC itself to take a good company public, since a lot of the people who are involved with that just get paid off whether or not there's a deal or no deal. So they're just pushing to take whatever company public possible so that they could collect some money and get themselves paid out, as opposed to focusing on putting together a really good deal to bring a solid private company public. And that's something that's kind of a broader issue across SPACs, but this is one led by Bill Ackman, as we've talked about, where I think it's one of those things where if you're following the money, I think he's going to do a pretty good job at bringing a good private company public. Looks like we've got our first comment, and it's that it's having a streaming issue. So let's see what's going on with that one real quick. If anyone else is having issues with the stream, please let me know in the chat, and I could try to fix that. If it's messing up for everyone, that's obviously not super helpful. But I guess we keep moving down this list. LOTZ, that's one we've talked about, and we averaged down pretty significantly as we've been moving through this one. We've got 35 puts that we've sold on this at an average price, if we go to our trade breakout, of $1.17 a share, which sticks our break-even price at $8.83. Still, it's one of those things where, obviously, since this started at about 10 or so, that is something, it's moved pretty significantly against us. Not obviously what we'd want to see, especially when a couple days back, if we back up, it was trading at around $11 pre-market. So we were pretty excited about that, just for it to fall back down to this $8.99 level. Excuse me. But again, our break-even price is down here. So we're still above that. And as long as we're above that, we'll make money. So that's kind of all we're focused on in the near term on that one. It's also pretty heavily shorted, I believe, reading that. So definitely one that's subject to potentially pop at some point if the shorts ever need to cover their shares. So moving down even further, CCIV, this one was one that actually went really well, and it was in our newsletter from last week. So that was super helpful. We were pretty correct when we made our evaluation about just the fact that it was one of these things super overvalued from a, I guess, just market cap perspective. And we'll bring the chart up really quickly while we talk about this. One of those SPACs that we like to talk about had the $10 price floor, ran all the way up to $65 damn near, just on the rumors and the news that they'd be merging with Lucid Motors. And again, Lucid Motors, as we talked about, doesn't have any revenue. So it's one of these super speculative companies, but at a share price of roughly $60 a share off this price floor of 10, you're paying 6x whatever valuation you had initially on the SPAC deal. So whatever the SPAC currently values it at today, you were paying 6 times that at $60 a share. And that's just not something that's sustainable. And we could see by this huge red candle the day after the merger, when it dropped down to 40, then continued further down to around $30 a share. Our thesis came true on that one, so we were able to close that one out for a pretty solid gain. So that was one that thankfully we were correct on in a week of a lot of red across the board. And going along with that theme of having a lot of red across the board, we had a SPX call spread, which was a general hedge to the market. That worked out pretty well. SOL 17 strike put. That was another one we entered pretty much at the peak of the week. Our timing was not very well. We've learned a lot of good lessons about just keeping some buying power on hand for when things like this happen, when it dips down from $18 to $12.54, which obviously is a little bit startling when you enter a play at 18. You think you give yourself a pretty good cushion with your break even down here, and then less than 24 hours later, it's far below that break even price. So that's something we definitely want to work on in the future, keeping a little bit more buying power reserved. It can get really easy to fall into this lull when the market's just pretty much taken a straight line up since last March, April, May. We could pull up the 180-day chart on SPY. While that's loading really quickly. Yeah, I mean, obviously we have this COVID crash. We're going to have to back up to a year if you want to see the full effect of the COVID crash right here. But I mean, from the, I guess, bottom that you could call it back late March last year, there really hasn't been much turmoil or terrible volatility in the market. So it's one of those things where there are a couple red candles here and there, but I think to a lot of the people in the Discord and a lot of the people who were following along with us and might be newer to the market, which it's okay to be new. Everyone was new at one point, no worries. But when you think about what's going on in the scope of the past several years of trends, these two red candles in here, I know for some of us in the Discord, and even for myself at some points, it kind of felt like the world was falling apart. I was losing a ton of money as we saw. I was a little bit over leveraged in my positions. So I definitely could have done better in that regard. But it's also important to keep in mind that things can get much, much worse. Obviously, we're probably not going to have anything like we had back in March with this big COVID crash. But even just this is a pretty small dip in the scheme of what we could possibly see, like back in September when we saw SPY go from 350 down to 320, and then again in mid-October when we saw it go from 350 down to 324. So those things can happen pretty quickly in the blink of an eye. And that's why we always want to keep a good amount of buying power on hand so that when the market does dip like this, we have cash free. We're not worrying about being margin called. We have the ability to scale into these other plays and just increase the amount of money we have on the table. We always want to keep a little bit of buying power, have a little bit of powder dry, relatively speaking, just in case things do pull back like this, so we can get stocks at nice discounts. And admittedly, self-reflection piece right here, that's something that we didn't do very well this past week, and we'll look to do better going forward. So back to our weekly plays from last week, Uxin. This was another one, kind of a Chinese used car consignment company. Not anything super crazy or groundbreaking, but the play that we had here was, I mean, it's moved between two, bottomed out at about 85 cents. There was a brief dip down to 72 cents, but for the most part over the past calendar year, it's been between $1.86. It looks like it's coming back down to the base of around $1.08. But what we were doing was we were selling these one strike puts for 10 cents a piece. And I guess I can go to the breakout here to make it a little bit clear about the result of that and how that would look. But our break-even price is 90 cents, which on the graph is all the way down here. So that's something we're comfortable with from an entry perspective, because that's right around, if you look at the I guess troughs of this chart, we've got a base here at around 87. We got a base here at around 93. And then we've got another base here a little bit lower at 85 cents. So if we were to be assigned on those puts, I'm perfectly comfortable taking assignment with an adjusted basis of 90 cents. So that was kind of the idea there. And that 10 cents of a return on 90 cents at risk represents a pretty solid return on capital, 11.11%. Excuse me. And again, we'll get that at March 19th, just provided Uxin stays above $1 here. I mean, it could dip, it might not dip. We never know. If we knew the answer to these things, we would be rich, and I wouldn't be here streaming. I'd probably be living on an island somewhere. But we just put ourselves in positions where we have some high probability of making profit and just let those plays work out for us. So that was the idea here. And something interesting, a little bit of a quirk about this trade, if we go over to the trade grid for Uxin, switch this over to single and show you the volume over here. There aren't a ton of puts being traded. So 74 were traded on Friday. We didn't actually trade any on Friday. I think we entered Wednesday and Thursday on this one. But what was interesting with a spread like this, and when something's traded at $1.16, I mean, if we look at an Apple or something and there's a 5 cent difference between our fill price, not a huge deal. But if we're looking at a stock that's trading at $1.16 and there's a 5 cent gap between the bid and the ask, that's pretty significant. That's roughly 5-6% return on capital just from the fill price that you get on that. So our strategy here was we initially tried to make a pretty big order for I think 20, 30, 40 of these puts at, when we were doing this, it was between 5 and 10 cents because we tried to enter it back around here when it was a little bit higher before the market took a dip. But it was between 5 and 10. So we put an order out for 10 and it didn't fill. So we canceled that order for 40. And what we ended up having to do, interestingly enough, with the way that this all worked out, is we started putting orders out in 1, 2, or 3 sizes. So we would try to sell 1 at a time. We try to sell 2 at a time. We try to sell 3 at a time. And slowly but surely, those would fill during the day. And we slowly accumulated the eventual position that we got to, which was 40 of these one-strike puts sold. So that was a little bit of a quirk, something with low volume. Obviously, I would have loved to have waited until Monday if I could do the same strategy and throw it at 15 cents rather than 10. Because again, that 5 cents difference is a pretty big difference return-wise when we're talking about percentages. But that was something I wanted to add to that in case you're in the future find yourself dealing with one of these lower price stocks that doesn't have a lot of volume. It's really important to be cognizant of the difference between the bid and the ask and how your fill price can significantly alter the risk to reward profile that you have when you enter into the trade. So let's jump back here real quick. Let me check the chat again to make sure nothing's going too crazy. Okay, we are good to go. Let's keep it rolling. Back to the weekly performance that we had last week. Next one, this is another one that I hate this even happened because typically, I mean, in the past, we admittedly have been getting pretty risky with these LODE puts. That was not a very stable stock, but it was one that, from a risk reward perspective, that we like to talk about so much. I was happy with where it put us, and that one paid off. We made, I think, between these three, about $1,600, and would have been more if we had held on, because these eventually finished worthless, but we were happy to take a profit when we saw it. But the idea between the AMD and Apple puts was that, you know, the market had pulled back a little bit. Let me take a look at the AMD chart. Here's what I was looking at when I entered into this play. It had been at 100. I like AMD as a stock. I think the demand for graphics cards and computer parts and things of that nature that they produce is at an all-time and sustained high because, I mean, there's a shortage of these things that we've been talking about lately. But the issue, though, is I entered around $88 a share. And I think it was a little bit higher than 88, maybe $88.50 on Monday morning, which I thought objectively was a pretty good price. You know, there had been a base around that 88 number, so I was trying to play the base. It had recently peaked at 100, so there was still some pretty good upside. It's not like I was buying at an all-time peak. So I was happy to enter the trade if we go to the 5-day chart right around here on Monday morning. And unfortunately, that unraveled quickly as it dropped down to below $80 a share Tuesday morning. And I was so excited to finally get into a trade like this where it wasn't this Hyliion or this LODE or these other super volatile stocks. And I just had a nice, consistent stock that still paid a good premium. But unfortunately, the second I did that, shit hit the fan in the market. It dropped pretty rapidly. But let's take a look at where we stand on that trade in the individual trade breakout tab that we have here. So yeah, 88.20 is when I entered, which I think was quite literally the highest that it was all week. Terrible luck. We got a $1.60 premium, which initially had our break-even price at $86.40, if I did that mental math right. So that was something, if we go back at the chart and look where $86.40 is, you know, I'm okay with that as a break-even price over 1 week for a stock as strong as this one. Now, obviously, you know, it did take a pretty big dip, but what we were able to do was roll our puts forward for a credit here. The difference between this and this, I think it's 80 something cents, 82 cents, I want to say. Maybe that's right. Yeah, I think 82 cents of credit, which lowered our break even from 86.40 down to 85.58 where we currently have it. And that is represented, I'll put it drawing on the chart, 85.58 is right here. So despite how terrible the market was last week, how big of a drop it took, with AMD finishing at 84.30 after hours on Friday, we're still only $1 off our break-even price despite how big of a drop it took. And when I talked a little bit early in the stream about getting a bit over leveraged, it's because I sold these puts using some of my margin privileges. So you'll know from our the videos and the strategies that we run and what we talk about, the amount of collateral required for a trade when you sell cash secured puts is the strike price times 100. So I sold these at an 88 strike price times 100. And I sold, how many of these did I sell? I sold 5 of these. So that's a $44,000 position, but because of margin privileges, it only took up about, I think, $8,000, $9,000 of margin to open this. So that was something where I was trying to leverage my capital a bit and come up with a nice return because we sold these for what, $1.60? So $1.60 times 5 of these times 100 is an $800 return off of $9,000 of collateral, call it, and that would have been an 8% weekly return. 8.8, we'll call it 9% weekly return, which is phenomenal and something I was comfortable with doing on a stock like this. However, like we mentioned several times, I probably sound like a broken record at this point. It sucked that I moved against us. So we're sitting on a decent loss from that right now, but at the same time, it's one where I was able to roll at the same strike. And by rolling, we'll go back here. What I mean by that is I closed out this 88 strike put. I closed it for $3.98 for the current week, which was last Friday. And then I opened it for even more of a credit for next Friday. And by doing this, typically when we do run the wheel, I would have taken assignment on this. But the issue is that if I did take assignment of those shares, I'd be holding $44,000 worth of shares. And that's something that I did not want to pay the TD Ameritrade's 8 or 9 or 10% margin rate on. So rolling the puts allowed me to not dip into margin to hold the shares. Let me rephrase that. I used margin as collateral, but when you use margin as collateral for selling cash secured puts, it's not considered using that money. So I don't have to pay interest on that $44,000. I only have to pay interest if I owned the shares and had $44,000 worth of shares. So that is the rationale behind me rolling these forward. I was able to get an 80 cents credit. And the good part about this is if this runs back to $88 next week, this is going to be worthless and we're going to pocket a 12.24% return on capital at risk, or not capital at risk, I guess we'll call it collateral since it's that $9,000. I have the exact number in here somewhere at 98.85. So just under $10,000 of actual buying power. But we'll get a 12.24% return on that, which over 2 weeks, if the stock moves against us, and again, this is still objectively, when I entered and when I would exit, the stock would have decreased. And for me to pull a 12.24% return on that, I'm perfectly happy. Even if it doesn't get back up to 88 next week, even if it's just on my break-even price, I'm going to do the same thing and keep rolling these puts down until one day it gets called away and I'll be sitting on a nice, hopefully roughly double-digit return. And even if it takes a month or two to do that, a double-digit % return over a month or two is always objectively nice, especially when the stock moves this hard against you. But again, I got a little bit leveraged by using $9,000 of buying power to open a $40,000 position. So that was objectively a mistake that I made as I reflect back on this past week. And then exact same thing with the Apple trade that we had right here. Let me put this back to where it was so this isn't misleading. Okay. Same deal with the Apple trade. Used a little bit of buying power. We have 8,200 of buying power here to open a lot of collateral. The issue with Apple is if we looked, AMD held up decently. Friday was a red day in the market, but we still were able to have a green day with AMD. So that was super, super helpful to keep me from getting killed too badly last week. But if we look at Apple, things were looking similarly nice. But right 5 minutes before the bell, it went from $124 down to $121. That is not fun to watch when you are trying to finish off your Friday and head into the weekend. But again, we'll go back to the profit tracking sheet. Our break-even price is 125.7 after rolling these forward. Remove this drawing really quickly. Back out. $125.7. Go back to the drawing tools. All right, that puts us right around there. So we're still decently below it, but again, this is another setup that was similar to AMD, where if you back up, it's off the all-time highs pretty significantly. I mean, 140, it was just there, what's this, February 5th, 2 or 3 weeks ago? That's, in my opinion, kind of nothing. So a stock as strong as Apple, again, it's one of these, I'm perfectly comfortable rolling these until the end of the year or as long as I need to get my basis low enough and finally pull a profit on these. And between Apple and AMD, like I mentioned, I was excited to get into some more stable stocks. It sucks that I did get leveraged and it went down, but at the same time, I do have a really nice, some really nice peace of mind knowing that, when things get bad for Apple, they can only get so bad. And I feel similarly about AMD. When we back up here in the scheme of things, it's all over the place. It goes up, it goes down. Hopefully we'll catch a green week or two, get back up to our 125 cost basis, but we should be able to keep rolling these puts week after week. Hopefully, assuming it maybe has a green week here, we'll be able to knock another $1 off our break-even price and just repeat infinitely until these puts that we sell one day become worthless. And that's basically the strategy we run, because Apple, it's not going to go bankrupt. We could lower our break-even price every week, but Apple isn't going to go down every week. And eventually, our break-even price is going to catch up with the stock price, and our position will no longer be a loss. We've got a comment in the Twitch chat. I might have missed it initially when it came through about what it means to roll over a put. And I think we addressed that, but just to kind of, from a literal perspective, talk about that one more time. We bought the put to close it out for the current week, and then we bought the exact same strike for the next week and sold it. So what we closed for a 4.7 debit, we were able to sell for a 5.5 credit, which means that we're getting more money from the next put than we paid to close out the previous put, which results in a credit as we roll the put, which from a literal sense, again, just means closing out the first one, selling a second one, and then moving forward with a lowered break-even price. So if you look in the formula bar here, it might be a little bit small on the stream, but we started off with the 128 strike price. We got $1.45 a credit on the first one, and then 85-cent credit to roll, which puts us at our new break-even price. And hopefully, like I mentioned a second ago, week after week, we'll lower this thing dollar after dollar. And eventually Apple's going to bounce, and we'll hopefully catch that and be back even on this, despite having pretty significant loss up front. But that's the thing about our strategy. These losses are all unrealized. So eventually we're going to be able to keep dropping that break-even price. Hopefully we'll get back in the game and things will be profitable for us soon. But the best we can do in the meantime is just keep going and running our strategy, lowering our break-even price week after week. And again, sounded like a broken record right now, but back into the weekly thing. Let's get into the last few plays that we had last week. So another one we opened was Hyliion, one that we very notorious in our Discord that's one we opened last October and probably was one of our worst trades of all time. But even though 2021 so far, we've made a really solid profit off it. But the losses that we had from getting in at roughly, I think when it was trading at $60 a share back in October, those are tough to recover. And I guess kind of to touch on this again, going back to CCIV, the way we felt so confident about this setup, this $10 price floor up to 60 and then a post-merger sell-off, is because of our close friend HYLN, where if we back up the chart again, $10 price floor, run up to 60 on the merger announcement, merger sell-off. It was, from my perspective, almost an identical setup, which I was super excited to play. Similar space, they play the electric vehicle space. CCIV was merging with Lucid Motors in the EV space. So that was one. It almost felt like deja vu, and I was very confident with that one, so perfectly happy to play a little bit riskier of a credit spread on that, which turned out nicely for us. And then, I guess going back to that play that we had itself was a 15-strike put earlier in this week. Again, after the dip, I think we opened this mid to late week when it was around 16, I want to say. But because of the volatility and the drops in the market, there was still a decent bit of premium. I know 14 cents isn't like super exciting, but if you take 14 cents divided by 15 minus 14, we had 14, use my head here, 86 at risk. It's a 1% return in 2 or 3 days, and that's perfectly fine with me for the amount of cushion that we had on that one. Even though on Friday it scared us a bit because it went all the way down to 14, but eventually got back above that 15 strike price. That's why patience is one of the most important things in this strategy, because even things can get pretty bad, dip down below you. Mean reversion is a pretty significant concept in the market. Things aren't going to go down forever. They'll bounce. Just stay patient. And the fact that you've sold options, let that extrinsic value melt away. That's exactly what we did on this one on Friday, and that worked out perfectly. And then Weight Watchers, perfect. Yeah, this is one from the newsletter last week that actually worked for us. So we sold these 25 strike puts. They had earnings. After the earnings, had a little bit of a heart attack on Thursday night because it dropped below our strike price. But by Friday, it ran all the way back up to 30, which is why I personally believe earnings are a little bit of a crapshoot price-wise. But we had good enough premium where we would have taken assignment at a 24.30 basis, which if I draw that on here, that's 24.25, so it'd be like a smidge higher. But if we back this up, on the 20-day chart, that puts us right around this other piece of support, this other area of support back in early February. So that was a basis that I was comfortable holding at because I knew when it previously peaked a few days ago, there was still some upside off that for it to bounce back up there, and that's exactly what happened. And we're happy to take a 70-cent premium on those 25 puts that we sold. That one worked out well. And the last one we have on here is Clover Healthcare. That one is not going terribly well for us. We got in at 12.65. 12.65 off this big drop here because there are some allegations about the legitimacy of the company. Maybe not the legitimacy of the company, but some of the claims that they're making. So we got in right around here by selling 12.5 puts, which I thought was a decent cushion for me. Obviously it was not, but we closed those, did the similar thing where we rolled these to the following month for a credit. We rolled those puts to lower our break-even price down to $10 and double check and make sure that's right. Yeah, $10.74 is our break-even price on this one. So right around, oops, I thought I had the drawing up. Try this again. Yeah, right around there, 10.75, almost, close enough. So this is our break-even price. We got in at, let me double check the spreadsheet. We got in at 12.65 back on February 10th. So that was right around here. So this is when we got in. And again, just to hammer home the idea of these strategies we run, why they work and why they work so well, is we got in here, and that's what February 10th is 18 days ago. And in just that short period of time, we were able to enter a stock here, yet in 18 days, get our break-even price down to here. And you might be thinking, okay, well, I mean, that premium was probably there for a reason. There was this downside risk, but it's one of those things, again, once we get to March 19th, first off, it could bounce up above this and we'll be profitable in the play like nothing ever happened. But second, once March 19th comes, we could roll these puts again, potentially roll them down to 10 for an even larger credit, and just get that break-even even lower. And week after week, month after month, our break-even will hopefully catch up with the strike price, or the stock price rather, and that's the idea with what we're doing in here. So they've got earnings on Monday, which we saw a pretty big candle. We could zoom in and take a look at this after hours. Some nice buying activity after closing at 9:40 on Friday. It got up to over $10 in after hours, which leads me to believe this is one that was shorted a little bit. People are either buying to cover their shorts, or maybe there's just a little bit of excitement that people wanted to get in on for earnings before they came out on Monday. Let's double check this real quick. Yeah, after market. So they're going to be Monday afternoon, which is tomorrow afternoon for us. So that'll be something to keep our eye on. And hopefully, obviously, we hope things go well and that some of these claims that are dragging the stock price down get addressed and hopefully resolved. And once that does happen, if it does happen, we back up to the 180-day chart here. There's a pretty high ceiling on this one for it to rebound. So this break-even price we've got right here is pretty dang low in the scheme of things. So that's one we're happy to have. Again, a month later, we're going to drop this even further. But there's definitely the potential for a rebound for us to make a good bit of our capital back if it gets back up into this area. So that's one, obviously, again, sucks in the short term, but all these losses that we have are unrealized, and we're just going to keep rolling with that, keep lowering our basis week after week. And hopefully some of these will become profitable. We can clear up some buying power and then get into some new plays, because I'm sure a lot of the people who follow us are probably getting tired of hearing about the same plays over and over. So that kind of wraps up what we had for last week. Give me 1 second, because what we typically like to do at the beginning of the newsletter is recap the actual trade ideas that we had in the newsletter itself. So let me bring that up. I think that should have addressed most of them. Okay. Yeah, so let me bring up the old hidden sheet 6 that we have in here. All right. Make all these messy little charts that I try to screenshot and throw into the newsletter. So the first one we had was Psth. That one was a 319.30 strike put. We talked about that a little bit. I'm confident that Bill Ackman's going to bring that bring a solid company public, and the hype will at least be enough to make these profitable, if not hitting max profit on those. So this is an ongoing play as we wait for 319. The next one was the Weight Watchers 226, 25 strike put. Those hit max profit. I can't spell. Try that again. Okay, perfect. Next one was UWMC. Love to talk about this one. 319, 7.5 strike puts, and those are ongoing. But again, they're in max profit territory, so nothing terribly concerning with that one. CCIV 319. Need to put that in the other cell. 319, 70, 80 strike call credit spread. I think this one we're going to call it resolved and call it a profit as opposed to max profit, since we personally closed out of the position this week. It's one of those where if you did hold this to March 19th and CCIV didn't make it up past 70, which, again, going back to this chart, they are a long way from 70, which is our max profit level. So if you really wanted to hold that and squeeze out the last bit of premium, you could call that max profit, but we think with the small amount of premium left on that, you're better served taking profit as opposed to letting it just expire worthless. So we're going to call that one profit. We're going to call that resolved. Let's change the color on these really quickly to indicate that they're ongoing. What color we want to use? That's a good one. And those were the 4 plays that we had from last week. So not too bad. We had 2 plays from our newsletter that were profitable, 1 hitting max profit, and then 2 that are ongoing. So really quickly, just for purposes of throwing this newsletter together, we are going to screen cap this, super high tech. For whatever reason, my snipping tool takes forever to load. And again, any questions you guys have as we move through this, if you guys want to see me take a look at any stocks as we go through this, any trade ideas of your own we want to go through and evaluate, feel free to throw that in the chat, and I'll be happy to do this. Because right now, I mean, I've got these trade ideas in my head, and I think we've got some good ones heading into this week because there are a lot of stocks that are on discount. But other than that, I mean, we could really take this wherever we want to go. MLCO, we could take a look at that one for sure. Let me throw that in my notes so we could address that in a minute. Open up the notepad because Google Docs is not working right now. CLO. Got that one down. Perfect. Let me save this really quickly. Trade idea results 228. This is probably the annoying part of this broadcast where I actually put together the newsletter itself. So just bear with me while I do this. Hopefully the previous recap was useful for you guys. Results 228. And just an update before that, we were 25 of 29 on our trade results for trade ideas for 2021. We are now 27 of 31, which I need to pull out the calculator again. 27 of 31 puts us at a 87.1% win rate for our trade ideas in 2021. And just in case you guys want to watch what I'm doing, I could drag this over here really quickly. This is what it looks like when I go through and make the newsletter. I'm going to have to update this text later. But let's get into the highest premiums. So this is another, we posted the put scan to our website today. So you guys should be able to see that. Highest premium puts right here, 228.21. And the other high-tech thing we do this for our newsletter is we take a snip from this directly and throw this into our newsletter. We'll cut it off here. File save as. Desktop, HPP 228. Change this one out, upload the other one really quickly. A little bit bigger, if it'll let me. It's not, whatever. Hopefully you guys can read that when the email goes through, but if you're watching this, you'll probably have way more info than any email could have provided you with. Update the link on this. Good to go. Okay, so let's drag this back over here. Take this off the screen, and let's get into that first suggestion that we had. MLCO looks like it's a casino company in Macau still recovering to pre-COVID levels. So let me zoom back out on this really quickly. Go back into the newsletter for the stocks in the chat. I'm going to be typing up a little bit of the analysis as I do this, so bear with me if you guys hear me type in or nothing's going on the main screen. So since this is kind of the first stock recommendation from the group that we're going to be looking at, I think this is a good way for you guys to see what I look at when I go through and look at a stock. MLCO. And it looks like it is recovering pretty nicely. MLCO. Yeah, 21.66. So off the bat, first impression from here when I look at something like this is what day is it? January 28th, it was at 15. Today it's at 22. Now we can back up a little further. There might be something I'm missing in the grand scheme of things. But it looks like, get a 3-year. Yeah, so back in 2018, they're up at 32. Dipped down in towards the end of 2018 to 15, where it bottomed out again recently. And this was the COVID dip, 1081. But it is up 2x off the bottom of that COVID dip. So typically when we look at things and plays that we want to run in the context of our strategy, something like this is a little bit from an entry point perspective. Now, no comment yet on the actual company itself, but we love entering on green days, or excuse me, we love entering on red days when things are beaten down. We can grab them up. So maybe one example would be back in September of 2020 when this thing dropped from 20 down to 16 and then consolidated around there. This is right about where we would have liked to get in if we saw something like that happen. Now, obviously, that probably wouldn't have worked too well off the bat as it went to 14, but like we talked about, stocks aren't going to go down forever. They're going to revert to the mean, and we would have been lowering our basis, our break even, all the way through this little stretch right here, and then it would have spiked back up, and we would have hit max profit on whatever it was that we were selling. So that would have worked out pretty nicely for us. But jumping back to the present and how we feel about this stock, no worries about, let's see, it is a little bit too late to enter, but if you did have those 7/16/21 calls, I mean, those are looking great. And from an exit perspective for you, if you are holding those calls, I mean, now seems like as good of a time as any to dump those if you're long on those calls, because one of the indicators we like to look at is RSI, which is the relative strength index. And this tells us if a stock is overbought or oversold. So anything above 70, as you could see indicated by this yellow line right here, means it's overbought. Anything below 30, as you can see indicated by this lower yellow line, means that it's oversold. And normally this works pretty well as an indicator. We could look historically at how it worked. It got over 70 once over here on this vertical line, and immediately after that it gave back pretty quickly. But it got down near 30 again right here, and after that spiked right back up. But at the peak of the spike, when it got back above 70, it fell right back down. So that brings us, there's another one we could look at back in November of last year where it spiked back up above 70, gave it back really quickly. So if we're using RSI and we use that as a trading tool, I think it is one of the better indicators out there. The RSI right now is at, what does it say, 79.52. When I move my mouse away from right here, you'll be able to see it again, but 79.582 is what the current RSI is, which is incredibly overbought. I think this is a great opportunity if you are long on those calls to exit, because I do anticipate that we'll probably see some sort of a pullback in this one at some time soon. To answer the question we just got, our streams are going to be saved. Yes, they will be saved and uploaded to YouTube. So if at any point during this you guys have to hop off, I know it's tough to carve out an hour, 2 hours, 3 hours to just sit down and watch a stream like this. So these are going to be saved down. I think this is the first one, so I did just update my settings to hopefully save these down so I can download and upload them. So hopefully that works. I hope it does work, but they will. My intent is to have them uploaded on YouTube just in case you guys miss bits and pieces of this, aren't able to hop on live when I'm available. Obviously, it's tough to match up everyone's schedules, so we are going to have these archived and uploaded to YouTube for future use. But to kind of close the loop on MLCO here, this is a great exit point, and I think going off this RSI indicator that we like to talk about does indicate that there's probably going to be a little bit of a pullback in the short term. So if this were my position, that was something I was doing, I would exit now, wait for a pullback maybe to the 20 level, because it looks like that's where the peaks of these are. So these were previously resistance, because every time I would hit the 20, it'd get knocked back down, 20 knocked back down. But when you break through points of resistance, those become places of support. So it broke through that, and I expect if it hits 20, it might bounce back off 20. But again, it's one of those things where you probably want to pair the stock action with the RSI at the time. Again, in conclusion, I'd close the position. I don't know when you entered those, but you've probably made a really solid profit if it was any time in the last month or two, because this thing has pretty much just been a straight line upwards. So next one we want to look at is going to be CLF. Shout out to J Marts, big member of the Discord. Love him throwing the suggestion in here. So let's get to that one. CLF. What do we know about CLF? Let's take a look. Cleveland Cliffs Inc. And I mean, looking at the 180 day, I think you already know what I'm going to say, but it was down at 490 last July. But that's not necessarily the worst thing in the world, because even after it did run up to 1877, it's back down to this 1334 level. And again, off the bat, we're just going to look at this strictly from a chart perspective. So this, like we like to talk about with the entry points, where we looked at MLCO, it had run up a ton and then fell back down, or excuse me, MLCO ran up a ton, didn't fall back down. This is one that ran up a ton, did fall back down. So this might be a little bit more of the entry point that we like to look at. So at 1329, let's zoom in a little bit to look at more recent trends, the 20-day chart. Exactly. These are some huge red candles off of earnings, though, it looks like. But it looks like earnings per share, they beat, and it doesn't give me any info on the revenue. So I don't know anything about this. So what you can do on stocks and trades like this when you have no idea what's going on, the Analyze tab on Thinkorswim is super helpful. All you do is you type in, I already forgot the name of the ticker, CLF. Type that one in, Cleveland Cliffs. It'll tell you right here it's a vertically integrated producer of iron ore and steel products. The company has upstream and downstream operations, supplies both customized iron ore, pellets, and steel solutions, yada, yada, yada. If you really care about that, you could read the rest of it. But at a high level, mining company. It also provides a pretty good rundown, a high level summary of what other research documents and publications who have done a lot deeper analysis than a quick high-level overview on a Twitch stream, what their opinions of it are. So CFRA as of 226, they gave it 5 stars, which is pretty high, but again, a little bit of a difference between that and the Market Edge 226 avoid rating. But if you really want to hop into these, you can click download, and that'll take you to the actual document itself. You could read a little bit more about what the analysts are thinking about that. Excuse me. But that is a good way to get a little bit extra supplemental info on a stock like this. But let's take a look, as we do so often, on the options. So the first thing I love to see here is that we've got weekly options. We look at the volume. There's plenty of volume, where like earlier in the stream we looked at Uxin, where there's 74 of these contracts that were traded last Friday. But we go back to CLF, and there were thousands. And a good way to summarize all this, because this can be a lot of data, is today's option statistics. You click on that, you can see exactly how many calls, exactly how many puts, which will give you the put to call ratio right down here. You can see what was traded a bid or below, ask or above, between the market. You can see some other interesting metrics that we like to look at, like 52-week IV high, 52 IV low, current IV percentile, and historical volatility as well, the VWAP, and current implied volatility of the stock. So again, if looking at RSI, this one's deep in the blue, so very, very oversold, but it is off an earnings event. I'm not too positive what the results of those earnings are, other than the fact that they beat. So another thing that we could do, we could look at live news, and it'll pull up here. There's an earnings call transcript. You can see earnings decline, revenue gains. It's trading lower after worse than expected Q4 EPS sales and results. And if we click on that, we could pull it in and actually read a little bit more. Well, typically you could read a little bit more detail. Here's one where you could read a little bit more detail. We'll make this bigger and take a look at what it's talking about. So they reported quarterly earnings of 14 cents a share. They missed the estimate of 22 cents a share, which is interesting because when we looked at this, it told us, oh, excuse me, I read that backwards the first time. You guys are very polite to not correct me. They estimated 27.7 cents EPS, and they came in at 14 cents, which, I mean, obviously not great objectively, but I do feel that EPS is probably the less important of the earnings metrics behind revenue. Revenue is far more important. Now, EPS does talk and give you some insight into how they're converting that revenue into actual profit. But between the three areas that we really look at when we look at earnings are EPS, revenue, and then guidance. Guidance is probably the most important because you could have a company completely miss earnings, but say, okay, we expect that our sales are going to grow 200% this next year as opposed to 100%, and the stock will shoot up even though they missed earnings. And likewise, you could have a stock that's trading at a decent level and then they kill earnings, but the management comes out during the earnings call and says, okay, the issue here is that we're going to miss earnings for the next 4 quarters, and then the stock's going to tank. And reasons like that are why I believe that earnings in general are kind of a crapshoot, because you can do all this analysis on the front end, have a really nice investment thesis based on industry trends, the way things have been trending for them, sales, estimated figures, reading analyst reports, and be right about their earnings and revenue, but they'll adjust guidance on you and the stock will crash. So that's something where you could do everything right, do everything properly, and still be wrong. But that was just a little bit of a tangent there about earnings. It looks like it didn't go well. This is a good entry point if you are bullish on the stock long term, bullish on miners. Again, dropping back to that 1-year chart. The one thing when we talk about this position, missed EPS due to an acquisition, good to mention there. So, I mean, it is one thing if you do believe, like you mentioned, it missed EPS due to an acquisition, that was justified. This is an example of a really good entry point as RSI is starting to dip on the 1 year. So one little quirk about the RSI is depending on the time frame that you look at, RSI is going to be different. So we have the 1 year chart here, it's at 34, whereas if we look at the 20-day chart, it's at 25 because there's been a lot more downward mobility. What's the word? I'm losing my mind here. Downward trend. I don't know. That was probably a terrible way to word that. A downward trend lately. So we see a lower RSI in the short term as opposed to if we back the chart up to the 1 year where we see a slightly higher RSI. So that's one thing to keep in mind when you're looking at RSI. It's somewhat comparable between different periods, but based on the time frame of the chart that you're looking at, it's going to be slightly different. But if you were to play this, again, one little other aside, I feel like I'm breaking into tangents a lot here, but our strategy is great for lowering our basis like week after week, month after month. The one area where we could run into a little bit of trouble here when we sell options is if the stock drops too quickly and we can't sell options near our break-even price anymore. For example, let's say we were in at 18 and we were selling 20 strike puts or something like that. That's probably not a good example because those would be in the money, but let's say we were selling 18 strike puts back at the peak right here. Those would have expired and they would have been in the money, so we could have done what we talked about earlier where we rolled these. But these 18 strike puts going forward now, if we tried to roll these or take assignment and sell calls, there's no premium at the 18 level here. You're not getting, your basis is being lowered by such a small amount. And that's why when we look here, when I pull in the the return on risk, which is the one metric that we really like to use to evaluate profitability of an option. Yeah, this is nice, 3.2, 2.08, but if we run into a situation here where it starts dropping even further, because this is a little bit of an area of support, it's stalled around this level, but if it gets down to this next level at about $8 or even $7, we could run into some issues. Because if we're trying to take assignment and sell calls that are $5, $6, $7 out of the money, there's no premium. You're not going to be able to drop your basis very much. So the downside risks are something that's super important for us to take into account. And just looking at the 1 year chart, just even if this does pull back to this level, you're in some serious trouble. There is that downside risk present, as opposed to where if we look at something else that we were looking at, like Hyliion, you're kind of back already down near this post announcement level. So there isn't a whole lot more downside room here. So this is one that we are going to talk about for our trade ideas of the week, where I think it's a good idea again, despite 2 weeks ago saying I'd never trade it again, but we'll go into that a little bit later. But just, again, the downside protection here, if you sell a 13 strike put, 3.22% return in a week is really nice. but that 13 strike minus the 40 cent premium is going to put your break-even price at 1260. And 1260 on this chart, you've got a long way down. So that's something, if you are super bullish on the company, have done your due diligence and feel that they are going to rebound from this, it's not a bad play. 3% a week is not too bad, but I feel like we've seen all too often charts like this where they run up, they start tailing down, and just slowly grind back down to these pre-spike levels. So this is one I'd maybe, if you do like the company, set an alert on. If it gets back to this 850, I think 866 is this level that we have right here, 899, $9 level, I think that would be a really solid entry on this, because if it kept dropping down to that level, you'd have some really nice premiums as well due to the IV from the drop. But it's one of those things we like to talk about. It's better to miss out on a good trade than be stuck in a bad trade. And I think one of the biggest issues that you could be stuck in a bad trade here if this pulls back to 8. So advice on that one, if it were me who were considering that position, would be to just hold steady on this, wait for a better entry point going forward. So I'm going to type a little bit of that into the newsletter we got. Check the chat real quick, see what else we got. We're going to talk about CCL, AAL, NCLH, Airlines and Cruises. Would be happy to talk about those in a second. We've got DM. No problem, J Mars. Thank you for the suggestion. So I'm typing these out really quick. Take a sip of water. All right. Let me type a little bit of this up into the newsletter really quickly, so bear with me. And in fact, just so you guys don't have to stare at a blank screen, I could go over here and tell you what I'm typing in here. Again, I'm going to say we like the fact that this has weekly options. So you have a chance each week to continually lower your break-even price. Additionally, these options offer some really nice returns from an ROR perspective. However, the issue we have with this one is the fact run up to last Friday's closing price, even after the drop. What was that price again? It was $13.34. And again, looking at that chart, and that's after being at a low of 263 less than a year ago. But that's, I don't know, that's the COVID crash. I don't know if I'd consider that. We could look at the 180-day chart. We could say at a low of 490 last summer. Biggest risk again is that a stock falls too quickly for us to sell premium on, and we can't effectively, my spelling, break even price quickly enough. Best to hold off on this one. Maybe to the 8 or 9 range. Okay, now that I got that typed out, thanks for bearing with me. We're going to get back into the analysis. All right, we have just hit an hour on the stream. Good stuff so far. We're going to keep it rolling. The next suggestion that we had in order were CCL, AAL, and CLH. Carnival Cruise, American Airlines, and Norwegian Cruise Lines, I believe. So we could look at CCL off the bat. Strictly from a chart perspective, obviously it's one of those you would have loved to get in back here, and it's run up almost just over 2x since then. But if we look at pre-COVID numbers, again, got to back up a little further. It was, let's see, about $50 before the COVID drop down to 7.8. Again, as a lot of you who are following along know, this was one of the most significant drops in the market with the COVID crash, since their business was directly affected and they were forced to shut down due to pandemic requirements. So the issue obviously is pending bankruptcy risk on a company that isn't allowed to run ships. And back here, I was a little bit more well-versed about what that bankruptcy risk was, so I didn't quite jump in on that. But we could take a look right now and see what's going on. I think a good place to start with this is maybe Google. We could talk about CCL bankruptcy risk. So December 1st, there's an article about bankruptcy still looming. That's still not terribly recent. Let's jump over to news, see if we can find anything. Seeking Alpha. This is honestly, Seeking Alpha is a pretty good site typically for stock analysis. See what we can do right here. Bankruptcy. Let's see. So it says, while management was avoiding the bankruptcy topic in the last year, the latest price appreciation in the company's 5-year credit default swaps in the last few months indicates that the market is more bearish regarding Carnival's future than a couple of quarters before. So that's not typically good to read about that. And another thing, just in general, this is kind of maybe a high-level macro view of what's going on here. Cruise lines are objectively terrible for the environment, and I think moving forward there's going to be such a push for this green energy and green businesses and things like that, that I think it could potentially start to become an industry that's regulated pretty heavily to monitor the output that these cruise ships have. So if you look at cruise ships pollution, luxury cruise giant emits 10 times more air pollution than all of Europe's cars. So, I mean, reading things like that in the news make me not too confident for the future of cruise lining industries, when I think such a push is going to be made for clean energy, like climate change, things of that nature for the environment, where cruise lines are going to come under fire sooner rather than later. I think they've stayed out of the headlines for things like this because they've just been shut down for a year. But I think sooner rather than later, that's going to kind of come to a head, and there's going to be something's going to give with that situation. Again, one more check on this for CCL. Bankruptcy. Let's see what we've got here. Same deal, that Seeking Alpha article. People are not happy about this one, it looks like. But I think the conclusion they came to in this one is that you're kind of gambling rather than investing in this one. We've got a bankruptcy bet. I think that one is well expired by now. Honestly, just a lot of older tweets. This one stayed out of the news recently. But let's talk about it from a chart perspective first, and then potentially an options perspective if it is something that you wanted to play. So obviously, if we do think that it is going to rebound, they'll be able to get back to full capacity without having to declare bankruptcy. We could see a move back up to 50. I think that could be something that happens. I just couldn't tell you off the top of my head, and I wouldn't put my money where my mouth is on this one about how long it would actually take for this to occur. So if we look at the options here, obviously with the amount of risk that we talked about, like that pending potential bankruptcy based off the risk here, they have weekly options again, really solid weekly returns. And this, even if you sell the 25 put, pull 1.87% a week, that puts your break even down to 24.5, which is right about here on the chart. And that's just for 1 week. Obviously, like we've mentioned previously on the stream, we could keep doing this week after week after week and driving it down. But again, like we mentioned with CLF, I believe was the ticker we just talked about, the biggest risk with our strategy that we run with selling options is the downside risk. And if it does come out that they're going to have some sort of restructuring, or that they need to issue additional shares and dilute the stock, like we could see some pretty significant downward pressure on this in the near future. And it's one from a risk to reward perspective. I mean, the reward here is what? That it runs from 26 back up to 50 eventually? Maybe, because even if they do go back into full service, they're sitting on a lot of losses, a lot of debt that they had to take out to survive this crash. Will it be even worth 50 a share if they get back up and running as they were at the end of 2019? That's a question I think still isn't an easy yes. So, I mean, the valuation could be somewhere in here. Obviously, I don't have the numbers in front of me, so it's tough to give too detailed of a valuation about what I believe that they're worth from a share price perspective. But this is something where I think the downside risk far outweighs the upside risk. We go look at another one of those travel type companies, American Airlines. Kind of similar here. This is one of the smaller ones. Delta Airlines is an example of one that I think it's rebounded incredibly since the drop, almost back up to where it was, despite them running flights at 60-70% capacity, which is almost insane. This is one I would not jump in on until there was another pullback. AAL from that perspective does look like a little bit better of a value play as we back up. We are at the 3-year. The other interesting trend as I look at the chart, I haven't followed this one terribly closely for the last 3 years, but it went from 60 down to 30 pre-COVID crash. It does seem like they had some issues of their own, and the fact that they're at 21, which is I think 50, they're a 50% increase away from getting back to that pre-COVID high. After, again, similar chart here to Carnival Cruise, flirting with bankruptcy. Just this whole industry together, I think we kind of, if you're bullish on it and are trying to make a quick buck on it, I think you really missed the boat when it was down around here, when you really had to take on that bankruptcy risk and all that uncertainty about the future of COVID and how it would affect these travel industries. But I think, especially since it's run back to 21, we could look at NCLH as well. I just don't think the risk to reward is there, since, like we mentioned, there are a lot of different mechanisms companies can use to fight off potential bankruptcy, between taking on more debt, which is a hit to the balance sheet, or issuing more shares, which would dilute the stock, or even if they decide to take a restructuring route that could potentially wipe out shareholders. So that's something I think as a whole, personally, I want to stay away from. Again, if it's something that you are bullish on, these put selling plays that we make are typically a little bit more conservative, and it just depends on what your investing thesis is. If you think, this slow grind upwards is going to continue, selling puts is great, because if there is a little bit of a pullback, you'll have a nicer basis. But if your thesis is that, okay, tomorrow everyone's going to have the vaccine, these things are going to be back in business, we're going to go and it's going to spike back up to 60, that might be one where you want to move away from an option selling perspective, because I guess as we sell puts, even if we did it like a 29 strike, the most we can make, regardless if it finishes at 29 or finishes at $290 a share, not that that would happen, but we're making this, the point is we're making the same amount of money. If your thesis is that it's going to spike up at some point in the near future, you might want to move away and maybe sell a covered call that's a little bit further out of the money, maybe a little further down the road. We could look at every strike that's offered here. You could sell 40, 50, I guess they only go up to 45, but you could sell a 40 strike call for, I guess, 20 cents. That knock your basis down to $29.30 in the next month, and give you the potential to sell these for 45 a share for a 50% gain overall on the trade, which obviously we will never turn up our nose at a potential 50% gain. But at the same time, I'll never tell you you're right or wrong about an investing thesis. I think the most important thing for us to talk about is just the best way to play it. So if you are bullish on this, there are two ways that you can be bullish on. Like I mentioned, it's either you think the slow grind, it's going to continue up, in which case I think selling the cash secured puts is the best option for you, or you are of the opinion that there's going to be a spike, in which case maybe getting aggressive with selling covered calls far out of the money would be the best way to play that, so you don't miss out on any of your perceived potential upside. So that kind of, I guess, would close the loop on my analysis from that one. Bankruptcy is just way too much of a question mark for something like that. I mean, if it were down here again, back at $10 a share, where you've got significant upside from here while also taking into consideration the downside, it's not too bad of a trade. But when we're back up to 30 on something like this, and you have $30 down, if you were to get wiped out as a shareholder while only having maybe 30 back up to get to pre-COVID levels, that's just not enough for me from a risk profile perspective. So the next one that we've got on the list is DM. So let's throw that one in there. DM, Desktop Metal. It's one of those metal companies. Okay. Again, this is one I've seen in the news, I've seen the ticker thrown around, but again, a good example of when it's smart to go to the Analyze tab over here and see what it is. Okay, so they are additive manufacturing technologies focused on the production of end-use parts. The company offers a portfolio of integrated additive manufacturing solutions for engineers, designers, manufacturers, blah, 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 blah. 3D printing. Okay, so it looks like, correct me if I'm wrong here, but this looks like one of those 3D printing plays. Judging by the price action here, I would imagine this was formerly a SPAC, but that's something, again, we could go onto the internet to check out. What's the full name of this again? Desktop Metal SPAC, maybe? Yeah, so it was formerly traded as a SPAC. We're correct about that. Not a ton of details on the merger itself, but again, we talk about risk to reward with these SPACs. We love getting in at this just above 10 price level pre-merger because that's when there's really not too much of a downside, because with SPACs, they're just a holding company full of cash. And this is, from a share price perspective, the value of the cash. Over the short term, the value of that cash really isn't going to change that much. So that's why we're comfortable getting into like $10, $11, $12 a share on something like this. But after it's run up to 35, obviously we would hate to get in at 35, but as we've talked about earlier in the stream, we love a good entry point after a pullback like this. So let's take a little bit more detailed look at the chart here. We've got the 180-day chart up. So let's draw some lines on here. We're first going to look at this from a chart perspective, then an options perspective, and then maybe take a look at a couple of the items in the financials. But we're back at 20, which if you look here, kind of a little bit of resistance here at the 20, but really you only see support. You see support here over a period from January 8th to January 14th. So about a week, there was some resistance at that, let's see, $20 level. So we could see a little bit of a bounce here. We may have already started to see a little bit of a bounce here from a chart perspective. This looks like a solid entry point. We like to pair that up with the RSI analysis that we do. And the RSI is below 30, indicating that it's very oversold. So I think from an entry point perspective, this one is pretty solid. 3D printing is something, one of those more futuristic type industries, and something that could be well perceived as a solid growth opportunity moving forward. We see that it previously peaked at 35, so if it did go back up there, there's still some really solid upside on this trade. Taking a look at the options chain here, and I got to be honest, I kind of like what I see from a premium perspective here. They do only have monthlies, but that is sometimes the case when you have lower volume. So what we could show here is the volume that we're looking at. I mean, decently high for a monthly for one day. If we look at these option statistics again, there were 17,000 options contracts between all option series that were traded on Friday. So if this is one that you were bullish on, I think this is something where our strategy would be a really solid way to enter the trade. So you could pull up, depending on how risky you want to get, you could sell at the money put for a 20 strike, which would pull an 11.58% return on risk, which for March 19th is 3 weeks away, I think. Yeah, 3 weeks away. 11.58% return just if the stock stays flat is really solid. And again, the premium on those is $2.10. So that would put your basis at $17.90, which we could put on the chart right here. If I could get to it, this is really difficult. Close enough, 87. So this is where we enter, and within 3 weeks, your basis would be right here if you were assigned on these shares for Desktop Metal. And then again, if you were assigned on those shares, we just run the typical HT wheel strategy that we like to talk about, where you take assignment of those shares and then sell covered calls, which this might be a little bit conservative of an estimate. We would be selling the April series if we were assigned on the March series. Probably something around 20 just to be conservative, since there is still a little bit of downside here, because I could definitely see it getting back to this next level of support here in the 15 range. But here's the way this would play out. If you entered this on Monday, you got $2.10 for these 20 strike puts. You're either pulling a really nice 11, 12% return in 3 weeks, which objectively is awesome. You're going to make a killing if you could do that every 3 weeks. But worst case scenario, it goes down. You're stuck with shares at a $17.90 cost basis, which is still a really nice discount from the current price. And you would take those shares at $17.90. You could sell 20 strike calls, which once that rolls around, April will be about 4 weeks away, so this might be a little bit conservative of an estimate, but you should be able to get, it would be $2.5 out of the money, so this is probably a better estimate, but you should be able to get maybe $1.20, $1.40, we'll call it $1.30, which would knock your basis down from $17.90 to $16.60. I hope I did that math right again. So basically in 3 weeks, I mean, relatively speaking, if shit hit the fan for you and you did have to take assignment and this kept dropping, your break-even price headed into April 16th would be here. So thanks to the premium that this offers, I like the long-term outlook of this stock. I think the 20 strike puts are a really solid way to enter this trade. Now, the only thing that I would potentially be hesitant on is the fact that, as we have seen, these things can go down pretty quickly post-merger. But looking at the RSI, looking at the previous peak, it looks like this is a really solid entry point on this one for a forward-looking business that, I mean, based on what they do, I wouldn't be too mad about holding a 3D printing stock for a while. And like we mentioned, month after month, we could just keep lowering our basis until eventually the stock price catches up with our basis, or we're stuck with a pretty nice gain from the premium. So I think that's a great suggestion for who threw that in the chat. This is one I might throw on my watch list personally because I think it's a really good opportunity. Thanks to this premium, thanks to where we can get our break-even price, thanks to the industry of the stock, the forward-looking nature of it. So just to kind of wrap this one up, I think this is a potentially really solid play at 20 strike puts if you want to get a little bit aggressive. But if you want to play it a little bit safer off the bat, you can sell the 17.5 for $1. Now, the trade-off here is you only get a 6% return as opposed to 12%, but even 6% in 3 weeks, that's pretty good. If you're turning your nose up at that, that's probably not for the best for you, but that would stick you at a 17.5 strike price minus a $1 premium. That would stick you off the bat right here. So as opposed to you taking, I guess we could talk about the two routes you could take. You can get a little bit aggressive with the 20 strike and in about a month and 3 weeks have your basis here. Or you could get conservative with the strike, smaller return, but in 3 weeks have your basis be right here. So that's something to keep in mind. There's obviously a lot of trade-offs in the option selling game between what premiums we want to get, what strikes we want to sell, where we think a stock's going to move. There's a little bit of, uncertainty in the market that might scare some people off a little bit, but I think the way we look at this is a really solid, safe play where there's sufficient premium to protect us. So DM, good suggestion, and I like that one. So I think I'll throw that in the newsletter and talk about, I think that's a pretty good entry opportunity. So let me type that up real quick. Okay, so now that I think we've gotten through anything that people threw in the chat that we wanted to look at, so let's get into some of the personal trade ideas that we're going to go through this week. And first off, what we like to talk about, one of these stocks that we talk about seemingly every week, except for the little hiatus we took last week, is Hyliion, HYLN is the ticker on that one. And again, off the bat, we love the fact that this has weekly options. You could go pretty far out of the money here and still pull 2.19. You could pull 3.53% return. And with the amount of premium these are offering, 14.5, where you pull 3.53% a week off 50 cents of premium, again, off that 14.5 strike minus the 50 cents of premium would put you at a 14 strike break-even point. So let's zoom in on that. And this would throw you here. If you sold the 14.5, this is your break-even price. I was a little bit below that. If we could back up a little bit further even to 180 day, it's probably not useful to have the big pre-merger spike in there. But this is essentially your break-even price, a price that it hasn't traded at. Let's back up a little bit again. Undo that drawing I made. Whatever. It hasn't traded at this price since, where do we intersect it? Here. This $14 price, it quite literally only traded at this the day after the SPAC made the announcement of who they were taking public. And this was back on June 19th, 2020. So the fact that you can get in on this play with the basis that it hasn't traded at in just under a year is really solid value. And that's going to be at the top of the line for our trade ideas for the week. So let me type that one up really quickly. HYLN, 3.5 expiry on that. And it's going to be a 14.5 strike put. Your return on risk, again, looking at this, is 3.53%. That's something we throw in the newsletter. Probability of max profit is something we also like to talk about too. So this part might be a little bit interesting because this is something I think is a little bit lesser known about how to evaluate some of these plays. Give me 1 second. Excuse me. All right, so to evaluate probability of profit, what do we know about hitting max profit on this? It's when the 14.5 strike put finishes out of the money. So something cool about Thinkorswim is you can pull in this option theoretical measure of probability that it finishes out of the money, aka probability that this hits max profit. So as we can see here, there's a 60.31% chance that we're going to hit max profit and a 60.31% chance of us getting a 3.53% return in a week is quite honestly phenomenal value. And something that we'll talk about real quick, which can be a little bit funny when you use numbers over a short time frame. We'll run to our website really quickly, go to the tools that we've got here, and the annualization calculator that we'd love to talk about. So we'll just call it a full week. We'll call it from the 28th, even though the trade's only going to be 5 days. We'll call it a full 7 just to call it an actual complete 7-day week. So the return percentage on this is going to be 3.53%. And that's a 725% annualized return. So if there are people who are watching this and saying, okay, 3.53% in a week isn't that good. Here's the deal. If you pull 3.53% every week, you're going to have a 725% return in the market. If you started the year with $10,000, you'd have $82,000 by the end of the year. And if you kept doing this 3.53% every week, you'd be up to $382 million by the end of year 5. But again, this isn't realistic. You're not going to get 3.53% a week. I'll tell you that much right off the bat. But the point of this exercise and to look at the annualized numbers here is just to explain the fact that a lot of people who come into the option selling game come from the option buying game, where you're chasing these 100, 200, 300% weekly, monthly returns. But in order to get these 100, 200, 300% returns, you don't need to put yourself in a situation with low probability of profit and just count on getting lucky. What you can do is get these smaller returns week after week and have them compound into these really nice annualized returns. So that's the approach that we take on this. We put ourselves in high percentage trades. See, we have a 60% chance that we hit max profit here. And we do so on trades that pay out decent returns so that if we get these week after week, they add up to really nice numbers overall. And again, you're not going to hit 3.35% every week. Otherwise, it would be almost way too easy to make money off something like this. But you are going to come not decently close, that's misleading. But even if you don't hit 3.53, you hit it this week, but you don't hit it next week, that averages out to maybe 1 or 2% a week. And even if you only hit 2% a week, it's a 233% annualized return. If you hit 1% a week, it's still 83.18% return annualized. And it's important to keep in mind our goal here is just to beat the market. And the average return in the S&P 500 year over year is just 9 or 10%. So if you think, 1% is so easy, that's super simple. I can get that in a week. I can get that in a day, maybe, no problem, just off a low risk trade. First off, you probably can't. But even if you do believe that that's the case, a 1% return every week is going to get you 83% a year, and you are going to crush the market. You're going to blow hedge funds out of the water. But just keep that in mind as we're setting these trades up and evaluating the return on risk as we enter them. So again, the probability of max profit here is 60.31%. Tap that into my newsletter really quickly. And the downside cushion is something we like to talk about as well. So how much money can this stock drop this week and we'll still make money on the trade? So we'll calculate this really quickly. We know our break-even price is going to be 14.5 minus, we'll call it 48, 49. We'll call it 49 cents of premium. I didn't mean to hit that. I meant to hit minus 0.49. So our break-even price is 14.01. Which means from the closing price last Friday of $15.12, you'd have to drop $1.11, which divided by 15.12 represents a 7.34% drop on the stock. So the awesome part about this, it might be a little bit self-explanatory as we talk about this, but this stock can drop 7.34% in the next week, and you won't lose a single penny on the trade. It could trade flat for the next week, and you'll make a 3.53% return. And that's why we love these option selling plays so much. And this is a stock we keep coming back to time after time again because the premium on it is just too good to pass up, and something that I personally believe is one one of the better values that we have available in the market. So moving forward, I think one thing that I do want to address is we had this in our newsletter, and we talked about the fact that, okay, we're never going to trade HYLN again, because what happened was there was a Goldman Sachs not short report, but an analyst rating that came out with a price target that wasn't very favorable. And that happened. When did this happen? It might have been right around this day when it went from 17.46, had a huge red candle when the analyst report came out, and bottomed out around 16. So a pretty big day-to-day drop. And that's when we said, we'd been in on this trade for a while. We said, that's enough. I'm tired of it. We got out here. And then lo and behold, 3 days later, it spiked up. So let's talk about why it spiked up and why we got out. So in the Goldman Sachs analyst report, they were pretty bearish on the stock because, I guess, from a high-level overview, let's go back to this Analyze tab so I can back these words up with a little bit of a source. They provide electrified powertrain solutions for the commercial vehicle industry. So the whole idea behind this company here is, look, you've got this huge fleet of trucks. Eventually, there are going to be regulations in the United States that say you can't have this many emissions. You need to switch to an electric vehicle fleet in order to hit emissions compliance. But here's the deal. All these companies, they're not going to be able to purchase electric vehicles overnight. That's just not something realistically they could do. So what Hyliion does is they come in and they have this technology they install in the cars that reduces emissions via natural gas and helps you hit those emissions targets without having to drop a ton of money on a full electrified fleet. Now, I do personally believe in the next 10, 20 years, we will start seeing these full electrified fleets, but it's going to be a gradual process, and Hyliion is just one of the companies along the way that will help that process along. So what happened with the Goldman Sachs report is they said basically, okay, look, we think not 10, 20 years down the road, we think a lot sooner, because battery technology for these trucks and these fleets is getting a lot cheaper. So I took a step back. It's okay to admit when we're wrong about a trade, because we're wrong a good amount. No one is correct all the time. But we took a step back and said, okay, if this is true about batteries, and I believe that it is true, there was some pretty solid evidence that battery technology is getting cheaper, and that timeline of getting all these fleets electrified is being pushed up pretty rapidly as technology moves along. But we thought about that. We thought about our investment. We said, okay, we've had a pretty good year in 2021 with Hyliion. It's important to know when to leave the table. So that's what we did. Unfortunately, we left the table right here as opposed to up here. But that was something we were comfortable with, because in the future, the short-term future, if that analyst report was true, the thesis behind it I didn't totally disagree with, so I figured it was a little bit too risky of a play for me. But lo and behold, maybe 3-4 days after we left the position, because we were afraid of the fact that they were going to get crushed by these battery companies, let's take a look at what Hyliion announced. So in the shittiest stretch of luck that we have had in a while, let's see what day this was. This was February 11th, right? Hyliion decided to announce that they have battery modules now. So we got out of this trade entirely because we were worried that they were going to get crushed by battery technology. And then sure enough, they announced right after we leave the trade that they they released a battery with 40% improvement in cooling, blah, 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 and all these improved efficiencies. So something we left the trade because we were concerned they were going to get crushed by. A few days later, they said, oh yeah, by the way, we have this. So that was pretty shitty timing on our part. But since then, thanks to the overall drop in the market, we're right back to where it was, even lower than where we exited. So, I mean, in hindsight, I could say we did a good job exiting that trade, but I'll tell you on February 11th, I definitely wasn't thrilled about it. But, the opportunity has again presented itself to get back in this trade knowing what we know now. So I think this is a good time to do so, and that's why we're probably going to keep playing this one going forward, despite the fact that we kind of swore this one off for a little bit of time. But just to wrap it up, our first trade idea of the week is Hyliion 14.5 puts. I think it's really solid value with the 3.53% return, 60% probability of max profit, and then additionally the 7.34% drop that you can endure in the stock before you lose a single cent on the trade. And that's really just the value behind these option selling strategies that we use. Okay, so moving on to the second one. This is a little bit, Hyliion was really the only one I had in my head coming into this that I wanted to talk about, that I knew I was going to use as a trade idea. So let's look at what we do when we come up with trade ideas. So a good place to start is typically our watch list. I've got one called HT Wheel Watch that I could share. And you can see some of the stocks here. Some of the bigger names that we talked about earlier, like we've got the position in Apple. We've got the position in AMD. This one's on here just because I like looking at the price of it, since it's been paired up with GameStop down here and just been, quite frankly, entertaining to watch over these past few weeks and months. Another one that looks like it's a pretty good entry right now is IPOF. So really what we're doing right now is just scanning these. I think it's a great idea to keep a watch list and have a list of stocks that you're familiar with. So if you're looking down here, you see this stock, this price. Okay, this is way higher. Obviously, you can see it went up 32% on Friday. So this is way higher than what it normally is. But if you see one that's way lower than it normally is, like I'll come down here, I'll say, okay, IPOF 1373 based off of what I've seen lately, just off the top of my head. Nice spelling. This seems like a pretty solid deal, and it is because it's traded so long around $15 a share. Again, backing up, this is another SPAC that we love to talk about with that $10 price floor. Traded a while around 12, 13, but recently spiked up to 18. Go back to that past 20-day chart. A lot of potential upside here. Looks like there was some decent trading in that $15, $16 level, but also a lot of potential here for a pop in the stock. So that's something we like to get in at. If we look at the March puts, we could say 15 strike put. Let's see what the math on that would be if we pull the calc back up. 15 strike minus, we've got $2.10 of premium here. 12.9 basis on a 1373 stock with the potential of a 16.23% return if this spikes back up above 15. I'll tell you what, that seems like a pretty good risk to reward ratio on that one. A 16.23% return in 3 weeks, just if it gets back up to this $15 level that it was previously trading at. And again, we like to talk about the SPACs. We did mention a little bit earlier in the broadcast that, let's see, open is another. Okay, I'll put that one on the list. Thanks for the suggestion. I actually read about that one this morning. It'll be interesting to check that one out. Okay, so back to IPOF. Like we mentioned, there are so many SPACs that are in the market right now. See, normally when I do my YouTube videos and I mess up and talk over myself and stumble over my words, I can edit it out. Not so much here, but we're going to keep it moving. But when we look at these SPACs, I think I heard that there were 5 SPACs per day in 2021 as of a few weeks ago, and that's just a huge number. Like we mentioned earlier, there's not a lot of incentive for the people managing the SPAC to bring good companies public, which is why I think it's important to invest almost in the person as opposed to the company, which is why in Psth we've invested in Bill Ackman's SPAC. That's someone I trust with the cash. And this one is one of Chamath's SPACs, and I think he's another person. I mean, he might be the king of SPACs right now between IPO, A, B, C, D, E, F, etc., with the amount of SPACs he's using to bring public companies to market. But this is IPOF. I believe from a market cap standpoint and a funding standpoint, this is one of the largest ones that he's done. So they probably are targeting a pretty solid company to take public. And the way we like to play these SPACs, as we mentioned earlier, like let's take a look at CCIV. And these charts that you see for these SPACs are all going to be pretty consistent. Let's take a look at the timeline of the life of a SPAC. So you've got it here. It's trading around net asset value. And honestly, back end of last summer, SPACs weren't that popular. It wasn't a lot of huge buying activity. Then you start to get rumors about what the potential merger is going to be. This is when, for CCIV that we're looking at, this is when we find out, okay, they're thinking about merging with Lucid Motors. Okay, it's starting to look more and more likely. And okay, the deal's confirmed. And then all of a sudden the merger happens and it drops off. We do the same thing. We'll look at Hyliion that we talked about earlier. Nothing's going on. Okay, they're going to merge with this EV company. Okay, they're going to merge. Merger happens right here, drops off. So the way that these work and the way that it works really well in the context of our strategy is if we get in this area before the merger over here, we could gradually drive our basis down. And then when it pops upon the announcement of the target, our options that we sell will expire worthless if they're puts, or if we've sold covered calls or shares that get called away. So that gives us a really good exit point for something like this. So when we don't want to be in a SPAC is after merger like this. Now you might say, okay, you're holding UWMC. That goes against what you just said. Again, we look at the lifetime of the SPAC here. Announcement, or rumor, Rumor, build up, it's confirmed. Then they have the merger. See ya. Down to 757. This one, we have a whole 15, 16-minute video why we think it's actually a good underlying company. So we're comfortable holding this one longer term, as we mentioned earlier on the stream. But going back to IPOF, in general, we want to get the hell out of the position before the merger. So since this one hasn't had one yet, we can get in at a decent price here. Definitely decent price basis-wise. We pull the calculator back up at that 1290 basis, which if we illustrate on the chart, get some drawing tools up here. 1 second. $12.90 is right about here. Missed it. Try it again. $12.90 is here. So if we extend this line to the left, back out. I mean, in the context of where it had the net asset value of 10, not super great, but again, this would be our basis if assigned on March 19th, and then we could take that basis of $12.90, sell April calls for another $1 plus, and get down to this area right here, which is a much better area to be from a basis perspective on a trade like this. So basically, to reiterate a little bit, we love getting in on these, lowering our basis before the announcement, and then we love getting out, kind of once we figure out when the actual merger is going to be. Hopefully we'll exit our position before then. And that was something I wish was an approach I had taken previously for some of these SPACs that we've played, but we've learned a lot as we've played more and more of these, and I think this is really the ideal way to play it, since the speculation creates a lot of premium in the options that we can take advantage of to drive our basis down in the event that we do have to take assignment. And if it goes back above 15, we don't have to take assignment. 16.23% return right there. That's something we're perfectly happy to have. So trade idea number 2 on the week is going to be IPOF 319 expiry, since these only have monthly options, and a 15 strike put. We're going to sell in the money here. But again, if you wanted to get a little bit more conservative, go 12.5 for a 2.8% return in 3 weeks, which I just think there's a little bit too stark of a contrast between the 2.8% return and the 16% return here for me to justify going down to the 12.5. So we're going to stick with the 15. But depending on your, risk tolerance, if you did want to go with the 12.5, again, the 35 cents of premium on that would have your basis down here off the bat. So a little bit bigger of a cushion, puts you right around the support level right here. Either way, I don't think you can go wrong. Safe, a little bit more aggressive. At the end of the day, neither of these are terribly aggressive because they're plays that give you a decent cushion. So again, to summarize this play, the return on risk here is going to be 16.23%. Probability of max profit here is a little bit lower, but that's okay in exchange for the higher. And again, this is probability of max profit. So as long as it finishes above 1290, we're going to hit a profit, and there's a higher. Even at 1250, there's a 70% chance. So I imagine there's a 60-something% chance that this will finish above 1290 going forward. But for that 15 strike, probability of max profit, 32.39%. But even a 1/3 chance that you hit a 16% return in 3 weeks, not too bad. Now let's calculate the break even. We know the break even is 1290, so our downside cushion is going to be, it's going to have to go 13.73 minus 1290. It's going to have to drop 83 cents, which off the current price of 13.73 is a 6.05% downside cushion. So again, this is one relatively stable. It's led by Chamath, who I think is the king of SPACs right now, and someone where I'd be comfortable putting my money behind. And that's why we're going to roll with IPOF as the second trade recommendation of the week. And hopefully one day I'll maybe be able to get graphics or something figured out here, so you're not just staring at all these numbers and you could kind of easily see up in the corner here or something what I'm playing as we move through our analysis. So moving on, we are going to go for a third trade idea of the week. And normally with the third one, we try to get into what we call is a 10-day play for earnings. So the idea is you pick a stock that's 2 weeks away. You sell weekly puts pretty much at the money. And I could pull up the article itself, but stocks typically rise near earnings. I don't know. Let's see if I can dig this up. Do stocks rise before earnings typically? there was a really nice research paper. I think this is it right here. Yeah, that basically was a pretty big study in the market that came to the conclusion that stocks typically rise around earnings announcements. So what that means for our perspective is there's a greater than 50% chance that if we sell an at-the-money put a week before earnings, it's going to make money, which gives us a little bit more of an edge. Since pretty much if you sell at the money, it's either going to trade flat or up or go down, which is a 50-50. But if there's a greater than 50% chance that it goes up, we get a little bit of an edge there. So we pick a stock that has earnings 2 weeks away, sell an at the money put expiring the week before earnings. If it goes up, perfect, we hit max profit. If it goes down, we take assignment, sell a call for earnings week since we're going to have inflated premium. And if earnings are good, it goes up, perfect, we get our shares called away for a profit. If it goes down, we close out those calls we sold for a profit and then sell another set of calls for the same week, similarly inflated earnings because the IV doesn't dry up completely off the bat. And then either we have 3 opportunities basically to get these shares, either have the put expire with us for max profit or get our shares called away for a profit, which over a 2-week span is pretty nice. And the worst case scenario, if things continue to drop, you'll just end up with the stock at a really nice discount from a basis perspective. So where do we like to go here to find these stocks and find the earnings calendar? It's going to be NASDAQ.com. They have a really nice earnings calendar we could look at. So they have them by day, sorted by market cap, which is good. So you don't have to worry about the issue I run into here on, let's see, you can go to the calendar here on Thinkorswim. And this is how you view earnings. And this is only going to show me stocks right now that, here we go, finally loaded. So this is everything. And if you look on Thinkorswim, it's kind of a mess because it sorts these alphabetically based off pre-market and post-market. So, I mean, you've got Zoom here reporting earnings. Obviously, that's a big one. But you're going to have to dig through that to actually find the big ones. I mean, if you're looking at, okay, URGN, I'm not even sure what that is. So it's kind of just a pain in the ass to have to dig through all this info. Thinkorswim does a good job giving you a lot of info, but I think as far as researching upcoming earnings and getting digestible information, this is probably the better way to do that. So looking 2 weeks away, we're not going to want something with earnings this week. We're going to want something with earnings between the 8th and the 12th of March. So let's move forward here. And kind of like what I was alluding to earlier, these get sorted by market cap, so it's super, super useful. You don't have to scour through just this huge list of letters and numbers to find stocks that you think you're familiar with. But looking Monday, there's nothing terribly big that sticks out here for me. We'll look at Tuesday. I mean, honestly, Dick's Sporting Goods is the only one that really H&R Block. I don't really have any super strong opinions. Nano Dimension, this is one that we've played also with BNGO. These are a couple hype ones that I'm afraid in the short term might have a little bit too much downside. So we're probably going to pass on those. But if you do think that those are stocks that you're interested in, this is a great strategy to run on those. Looking at Wednesday. Man, I mean, for the most part, it looks like earnings season is kind of mostly over for a lot of these bigger companies. So you're not going to have a ton. This is where I like to look a lot more. Okay, Oracle is one I have a pretty strong opinion on because of the deal that they've struck. This is a little bit anecdotal and not, I guess, a commentary on their overall operations, but one bullish thing that did happen was the fact that they won the contract once TikTok made some sort of partnership with the United States. Their service, or I guess their cloud provider shifted from, I believe it was Fastly over to Oracle, so that was kind of a big win for them. But it looks like this Thursday that we have, March 11th, there's some really good names. Ulta's a big one. Slack, if you're bullish on that one. Adobe. But for the purposes of what we're picking here, let's take a look at these charts. We can go one by one here, really. Take a look at Adobe, ADBE. That one's pretty expensive. So if you wanted to sell puts on this one, I mean, it would require 40 grand of collateral per put sold. So that might be something we want to stay away from for purposes of recommendations for the newsletter. Oracle, let's take a look at Oracle. Yeah, that one's run up a good bit lately as well. Like we mentioned earlier, we like to find stocks that have decent entry points. Although this isn't the worst in the world. Let's see. Let's back up a little further. Yeah, I mean, objectively it's high, but it trades in a pretty not the widest range of them all, so that's something I wouldn't feel too bad about selling an at the money put at. Yeah, and I mean, for 64.5 at the money, 1.44% for a week. Can go back to this annualization calculator that we had up. 1.44% for a week really isn't bad at all. And that's going to annualize to something, put 1 week in here. Going to annualize to 138%. So, I mean, 1.44% a week is objectively pretty damn solid. So, let's see. We can go through the other ones that we were looking at as well. Let's see. DocuSign's also a good one with the advent of, a lot of the more remote work. Another company that we think, probably reflected in the chart. Yeah, you see it went from 35 COVID to 264, but then down to 266. So again, we like to talk about entry points. This could be a pretty damn good one going from, oh my gosh, yeah, this is great. 275 down to 226. So this is a really solid one. And if you sell at the money, oh man, you can get 3% return weekly just on this. And then obviously you look at March 12th earnings week, the premiums are incredibly inflated. So you could essentially open a 225. Yeah, 225, we'll call it just out the money here for a 3% return. This will put your basis at 225 minus 6 down to 219. And then if you wanted to sell covered calls, you'd be able to drop it maybe to almost 209 here. So you'd be able to drop that basis if we back up to about here in just a couple short weeks, which, judging by this chart, I think that's a very good place to be. So, just to comment on that Clover Health comment. They've got earnings Monday, and I guess is that assistant product and technology showcase. That's something that's definitely new news to me. If you know anything about that, feel free to throw it in the chat about what day it's on. But earnings are Monday, and I think maybe that might be similar to what you're talking about with that. But definitely a lot of positive catalysts coming up, so I'm not too worried about the Clover position that we do have. And if it was one that you're looking at, it is maybe a bit of downside risk due to some of the allegations that have been thrown at there, but I don't think Chamath would take anything too risky public like that. So entry point rise, it's perfect. Then we got another one. I've been trading for about 6+ months and still haven't grasped the concept of trading, and I try to ask people where I should start. Good, March 2nd. Perfect. Thanks for that info. That's definitely something I'll keep in mind. New tips for traders and where to start. Okay, so I think there is a little bit of to jump from an aside on what we're doing right here. I think this is a really important question because a lot of people, with how popular the market's gotten lately, are brand new to the game. Everyone was new to the game at one point. We've been doing this for a little over 8 years, so we've got a good bit of experience, but at the same time, I definitely remember what it was like when I first started out. It's tough when you start because there's so much information. You see what is something we're trying to combat with what we offer, but so many people on social media, you'll see them on YouTube ads saying, oh, you see me driving this Lambo around, it's because I turned $1,000 into $1 million and I'm rich now from the stock market, when that's just not a realistic approach, and that's something we really try to combat. Thank you for following too. I'm glad we got that notification working on the screen. But that's definitely something we try to combat with what we offer here, and the education that we offer is the fact that I think it's so easy for new traders to fall into the trap of seeing people who turn 1K into 10K or 1K into 10K into 50K and things like that. Because when you're looking at things like Reddit and you're seeing what's on Twitter and gets shared, those are the posts that get all the likes and retweets and get voted to the tops of the subreddits, because it's fun to look at people who have made a ton of money overnight on a super lucky play. But I would ask you at the same time, if you see someone who plays the lottery and that they win the lottery, do you think that makes it a good idea for you to play the lottery? And I think that's a no, because what they're doing when they buy these calls and have these incredible games, they're putting these subs in these positions where it's far more likely they lose every dollar they put in as opposed to making the profits that they made. So what we do with our strategy here is we make a lot more high percentage plays, but to back up and answer the question, where do you start? There is a little bit of, I guess, a process to getting to the level of knowledge I think necessary for selling options. And it's first just understanding the market, which I think can be done. They make it so easy to just start off now with Robinhood and just buy fractional shares in the stock, watch stocks, understand how things move. Technical analysis is something I'm kind of 50-50 on. I do like to talk about areas of support and resistance, things like implied volatility and RSI. I think indicators like that are important. Whether or not you think, chart patterns, things like cups and handles, like different candle shapes are important. I personally don't, but I wouldn't let that stop you if you think that's something that's useful for your trading. That's just not something I personally use, but there are really, honestly, I think YouTube's a great place to start, even just a trading for beginners search. I'm not sure how much you know off the bat because there's people who are new to trading. There are people who are new to trading options. There are people who are new to just, stocks in general and things like that. And there's so many different areas of the market that you can learn different trading strategies. But if you came to the market knowing absolutely nothing, I would recommend, either paper trading, which is something that TD Ameritrade allows, or just throwing a little bit of money into an account, whether it's Robinhood, whether it's another brokerage that you have access to, and just buying fractional shares of a stock, maybe a company that you like. Maybe you're into building PCs and you want to invest in a little bit of AMD and just study the stock and watch how it moves, understand how different news affects the market, get a feel for how much things move up and down during the day, get a feel for how different industries move. And I think that's probably the best place. I think experience really is one of the best teachers, and paper trading allows you to do that, or trading with small amounts allows you to do that without too much risk up front. So that's something I think is useful. Again, back to the idea of going on YouTube, just trading for beginners videos. I think there's some really, really solid resources out there that address all of that. So going forward, I think that's, if you're just getting into trading, first thing I would love to tell you is don't get overwhelmed, don't get discouraged, because it's a ton of info and no one was born with knowledge of the stock market. Everyone started in the exact same spot that you're in. So don't get discouraged, just keep at it. Experience is the best teacher. Paper trading, maybe small amounts. And that's awesome. You've been looking at technical analysis. You're trying to grow as you learn. And from the fundamental side, that's something we like to cover a lot. And we really haven't made a ton of videos about fundamental analysis. I think we did one on UWMC, and that one obviously didn't go too great for us, but I think the points that we made in the video and the analysis we did kind of hold strong. But that is something, the stock analysis side of things, now that we've built out all of our strategy videos, is something I think we'll try to get more into. And obviously, we're not the only people who are doing this. So if you are able just to hop on YouTube, look up different technical analysis for beginners, analyzing financial statements for beginners, I think is a really good way to get started, and then try to apply that to your trading. So a little bit of an aside there, but back to what we were doing before. DocuSign, I think a great setup here, great entry point after this drop from 270 down to the lows of 226, where it looks like it's bouncing around another relative level of support in this 220 area. And like we mentioned from the 10-day strategy, we'd be able to get a basis of roughly probably 209 here. So that's probably what we're going to go for to our newsletter for a recommendation. So we're going to throw DOCU. 3.5 is the expiry on those. 3.5, 225 strike puts. Those are going to give you a weekly return of 3.05%. Probability of max profit, again, is 51.89. So again, high percentage trade where it's likely that we hit max profit. Downside cushion on this one, going to be a little bit lower, but that just comes with the territory of it being a more stable, stronger stock. So 225, we'll call it. Let's see what the midpoint is here. 665 is the midpoint, so we'll call it 665 of premium. Means that your break-even price on the initial put you sell is 218 minus 35, which would be a 226.66, an $8.31 drop from the current price of 226.66, which represents a 3.67% downside cushion on the trade. And again, this is the 10-day play strategy, so don't run into this play unless you can afford to take assignment on the stock, sell covered calls over and over and over again until hopefully those shares are called away. But I mean, best case scenario, I think we're 3 for 3 or 4 for 4 on what we've run over the past month or two with this strategy. So you'll either hit max profit on these or get those shares called away pretty quickly. I think this mitigates a lot of risk while still allowing you to take advantage of inflated premiums around earnings time. So that DocuSign 225 strike put is going to be our next weekly recommendation. And then since that was our earnings play of the week, we'll do one more. And I think let's take a look at our scan. We do have a video about how we set this scan up, but this one gives us objectively, we'd like to talk about ROR. We were just looking at one with 3% in a week, but there's some out there with 35% in a week. But obviously we look over here and it's GameStop, so I wouldn't exactly recommend playing something like that. But this scan here gives us the objectively the best return on risk in the market for weekly puts. We've got everything March 5th expiry on here. So a good way to kind of use this information is if you don't really know what you want to enter into, and we're kind of in that situation here. I think there might be one, maybe OPTT might have a good entry point here, so we might make that our fourth trade idea. But if you are out of ideas, running the scanner and running through the list, sorting it by return on risk, and just looking at the tickers here and saying, okay, Fubo, I'm pretty bullish on Fubo. I think Fubo is going to go up. I personally don't, but for example, if you did, you could look at this and say, okay, wow, I could pull almost a 10% return if it just stays at 35 for the next week. So as long as Fubo holds here, you're making 10% in a week. And even if it doesn't, you now have a 32 basis in the stock, which is down here, representing a pretty nice discount off what it was going for in the market had your original plan been just to purchase shares. So that's the value in, using options to manage positions like this, and that's why we do what we do. So that's an example. If that's one you're bullish on, great one to enter. But just running through the scan and keeping your eye on tickers and saying, okay, I see something that I think I'm bullish on. This is something I want to enter. That's kind of the way that you want to use this scan. But I think for the fourth trade idea, we're going to jump back over to our watch list and talk about OPTT. Let's see. So what we would want to do here, since the strikes are pretty well spaced out from the current price of the stock, you got 5 strike put, 2.5 strike, which is pretty far out of the money. Obviously 5.26% return in a month, or I guess 3 weeks at this point, isn't too bad. We could take a look at and actually give you hard numbers behind that. But if we opened one on Monday and expired March 19th, and we got 5.26%, still 182% annualized, and that's a really solid return. My day is going great. How are you doing? Love that you've popped into the chat from the Discord. Trying to get the Twitch as active as possible. We'll get there one day. Maybe the first couple streams we might not have the biggest audience, but hopefully we'll get there soon. Anyways, back to the point that we're making about OPTT. 5.26% isn't that bad, and if that's the route you want to go, your basis, again, like we talked about with Uxin, really big difference here between getting a fill at 10 cents and 15 cents from an ROR perspective. This is something you want to be really mindful of, the limit price you put in, how patient you are at the fill. If you can get 15 cents, that'd be awesome. If you get 10 cents, you're towing the line a little bit about cutting into your return on risk. So that's something you want to be cognizant of if you do go to the 2.5 strike put route, and that would stick you with the basis 3 weeks from now of 235, which is down here. Let's see. And again, we talk about this all the time. I probably sound like a broken record with how much I've brought this up, but there is some downside risk because it was trading pretty low. It spiked up to 7.3, but now it's dropped down to where we feel is probably a better entry point on this stock, which throw it into the Analyze tab. They seek to commercialize its systems. Let's see. They generate electricity by connecting renewable energy of ocean waves. So again, I've talked about this a little bit. I'm super bullish on the future of green energy in the long term. So this is an area that I'm happy to be invested in, and I think a company that's doing something pretty interesting from that regard, using the energy from ocean waves to generate that renewable electricity. So this is one, long term, if we get assigned, we get assigned. I'm okay holding these shares at a 240 basis. But for the actual trade that we want to run, what we're going to do here is sell covered calls. So typically with the HT wheel, for those of you that follow along, we start with cash secured puts, and then we sell covered calls if we get assigned. But since this is kind of not a low ROR, don't get me wrong here, but for the amount of risk in this play, since it's run up from 40, really from, I don't know if I'd even count that, since it's run up from, what's this level right here, about 73 cents lately, there's still a little bit of downside risk that it could drop back to $1. And I don't know if 5.26% really satisfies the downside risk that we have right there. So I think I do want to leave myself the potential upside of getting up to 5 if we bounce back up there. So the play here is going to be to buy these shares and then jump straight into covered calls. And how that looks, we could actually jump back into our profit tracker here. Got a tab in here that I typically use to build out potential trades. So OPTT, Start date's going to be, bear with me as I get all this info thrown in here really quickly. Delete all that out. So it's going to start at $3.67, as we can see up here. This is messed up because it's calculating something incorrectly. Whatever, I'm not even worried about that right now. And I guess the play, we could just use this from 100 shares. We'll talk about OPTT shares. We're going to sell one covered call. Delete all these because these are irrelevant now. And OPTT again, 367. And that's where we're going to get these, 367. And we're going to sell OPTT 319 5-strike calls. Now we could have gone the route of, what's interesting here, let me talk a little bit about something called call skew. And let me type that in here for you so we can see it on the screen. Call skew. So we're trading at 367 right now. Let's put 367 in here. Let me make sure I don't run in. I've got, for whatever reason, I have my collateral hidden. Oh, that was the collateral tab. Whoops. Hold on, bear with me. I'm losing my mind over here. E2, 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 A3. That was based off this, which is G19 divided by D16. Okay. So I need to stop making this white font because this makes it difficult for me to follow along what I'm doing. Bear with me. So the amount of collateral on this trade is going to be 100. Well, actually, here's how this is going to work. Let me back up a little bit. So we're selling, let's get this play, put in the spreadsheet first before we talk about this. We're going to sell the 5 call for 30 cents. Maybe we might be able to get a fill at. We'll say 30-cent premium. Good Lord, I was on the wrong cell. Really killing it over these last 3 minutes here. Bear with me. Okay, so the amount of collateral we have in this trade, get this out of here, over here, is going to equal the amount of capital we have at risk. So it would be 3.67 times 100, but since we get 30 cents of call premium, it's really 3.67 minus 0.3 then times 100. So we really only have $337 at risk here if we just do one covered call. Now I probably would do something like 1,000 to just get a nice round. Nice job. I should probably make this reference to sell so it updates when I update this. I mean, allocating 3K, I guess from my perspective, obviously everyone's portfolio is different. The good news is you can enter this play with as little as $337. But so say nothing happens. We get an 8.9% return here over 3 weeks, annualizes to 4.12%. But let's talk a little bit about call skew as to why we would sell a covered call as opposed to jumping into a put. So a put is, let's see, dollars OTM. The 2.5 strike put equals the current stock price of 367 minus 2.5 means that it's $1.17 out of the money. The call, not call skew, damn it, equals 5 minus the current price of 3.67 means that the call is $1.33. So what's interesting here is that the 2.5 strike put goes for 15 cents, but the 5 strike call goes for 30 cents, almost twice as much. And when you think about options, the things that are closer to the money are going to be worth more. But what's interesting with this one is the 5 strike call, which is further out of the money, 5C, then the 2.5 strike put will go 2.5P. Despite that, it's almost double the premium of the 2.5 put. So this is a situation where you collect more premium actually from selling the 5 strike call, even though it's further out of the money, which is really strange, but that situation is referred to as call skew, when the calls of a stock offer more premium than the puts. That's what the skew refers to. So that's why we're going to opt for the 5 strike call as opposed to the 2.5 strike put. Now our break even right here is going to equal 3.67 minus 0.3. It's going to be 3.37, which objectively is way higher than the potential 2.35 basis that the 2.5 put would stick us at. But if nothing happens on the 5 strike call and it stays flat, we get 8.9%. If nothing happens and we stay flat on the 2.5 strike put, we get 5.26%. So that's already an advantage right there. And let's say OPTT, looking at this chart, bounces all the way back up past 5 to where it previously was, in the 6 or 7 range for a brief moment. We'll have these shares called away for $5 a share, meaning we get a $133 gain on the stock, $30 gain on the call we sold for a 163 total profit divided by a collateral of 337. We leave ourselves the opportunity to have a 48.36% return in just 3 weeks. And with the stock this volatile and the industry that it's in after getting beaten down a little bit, this is really a play where we want to leave ourselves that upside. So you surrender about 80 cents in basis off the bat by going with these 5-strike covered calls. But the benefit is that you leave yourself open to pretty much a 50% return at max profit, which is within the realm of possibility. And if we want to talk about literal possibility, we could look at the percent that it finishes out of money. I guess for this one, if we wanted to call it away, it'd be the percent that it finishes in the money. So there's an 18.31% chance on this stock that we hit a 48% gain. And I think that's phenomenal, and that's why that's going to be the 4th and final trade idea that we have in our newsletter for the week. So it's going to be OPTT 319 5-strike covered calls. Now let me circle back to the stream real quick. We've got open, that's OPEN ticker, and that's the last thing that we are going to look at that we had on our list. And if anyone's still having streaming issues, let me know, because that might just be my internet. I've got my stream up on my computer as well, and it's kind of lagging a little bit, but that might just be on me. I'm dropping 2.6% of frames right now, so it's almost definitely my issue. But if you guys are having issues on your end, let me know, and I could look into something in the future to hopefully increase the quality of that. So anyways, back to the final thing that we are going to cover in this stream today. Open, OPEN, is the ticker. Let's talk about it from the analyze perspective first. It's a digital platform for residential real estate that enables consumers to buy and sell their home. So what I read about this one today, I actually saw this when I was reading through one of the investing subreddits, was that it's founded by some ex-Google guys, and it essentially uses AI to issue loans. And due to the, I guess you could call it edge or advantage that those AI distributed loans creates, they have 20 or 30% lower defaults, which allows them to get a much better return on the loans, having to write off less bad debt and things like that, and really just helps from a return perspective as compared to other typical, I guess, mortgage or loan companies. So let's take a look at the chart. First and foremost, again, was it 40? Okay, all right. Now that we got the 180-day chart loaded, it looks like it's run up a little bit more than we originally perceived, but it's gone from 1055 up to 40, but again, down from 40 to this 28 range. We look at implied volatility. It's a little bit on the lower side, which, maybe in the middle relatively, because it traded lower than this for a good while. But from an entry perspective, not too bad, 28.56. We look at the options it offers. It's a monthly chain. Let's check the volume down here. Looks like there were 27K plus 6K, 33,000 contracts traded last Friday. Let's see, we got a comment. It also offers cash offers to homes, similar to what Zillow started doing. So that's also a really interesting tidbit of information, because Zillow pretty much is dominating, quite honestly, that home buying and home selling market from, I guess, a non-broker perspective. So if they are able to get a portion of that, because that looks like it might be the direction we're moving towards in the future, that could be huge long-term for the company. But looking again back at the options here, we are seeing again some awesome premiums here for 3 weeks out. We could sell at the money, get 11.78%. We could go super conservative and say, okay, well, it dipped down here. It dipped down to 22 at this level back at, year end, December 31st, 2020. So let's say we wanted our basis down there, even though it's only trading at 28. Well, guess what? We could sell a 22 strike call for 280. That would put our basis below that, or we could sell a 23 strike call, which would put our basis damn near right at it and get a 3.72% return in 3 weeks. Or if you really like the company, I think there is some upside to get back to where it was in that 40 range. There's nothing wrong with selling at the money here. And you could pull, let's see, 11.78% off $3 a premium, which would stick your basis on a 28 strike, put it $25 down here, which it hasn't traded at since January 28th. And all we would need is for it to stay above that level until March 19th, which is 3 weeks. So it's been above this level for a month, and we just need to stay above the level for 3 weeks, and we'll make money on the 28 strike puts. So I think that's an awesome suggestion. I'm glad we looked at that because I think that's something I'm going to throw on my watch list right now because I think it's a great combination of premium. Like I mentioned earlier in the stream, I'm definitely low on buying power after what happened last week, but if I do get some cleared up, that is definitely one I think I'll be taking a look at moving into sometime in the near future. So that pretty much sums up what I wanted to get done on the stream today. We recapped what we did last week, talked about some of the scanner puts that we saw come up, and then went through a lot of you guys' stocks that you want to look at, and then some of our own personal trade ideas. So I think we got, all in all, some pretty good stuff to look at as we head into this week. Again, that's all going to be consolidated into an email newsletter that will be distributed tonight. And if you want to sign up for that, let me pull my browser back over here. The sign up to do that, if you aren't already signed up, is right on our homepage right here. Should be right here. Yeah, there it is. So you throw your email in right there, good to go. You'll be signed up for it, and it'll be distributed later tonight. Again, if you are coming from our Discord, welcome. Always happy to have people in here watching us. But if you're not and you're coming just randomly from Twitch, you saw the link on Twitter, someone else shared it with you. Come on, join our Discord. We've got, I think, up to, gosh, let me check real quick. Server settings, we got members. We've got up to almost 1,900 people in the server right now. A bunch of like-minded people who are doing the same thing, all different account sizes, all different knowledge levels. So you're sure not, even if you're a beginner or a super experienced trader, there's going to be a niche for you in that Discord, and there's going to be something I think that you'll find useful. We've got our profit clubs that show the amount of people that have made different profit levels while they've been in our Discord with our strategy. And the thing about our Discord is it's been up and running for, I think, less than a year, and we've got people who have made, one person who's made 6 figures. We've got a few people who've made 50,000, and then a bunch of people who've made 1,000 and 10,000 just from our strategies in the time they've been in the server. So if you're not on with what we're doing yet and you're trying to get started with selling options, I think that's definitely encouraging to see people who have done it successfully that aren't just me, because, I mean, anyone could go online and BS something that they've done, which kind of circles back to the issue I have with a lot of these people saying they've had 1,000% returns. But when you've got a whole chat room of people who are having similar success, that I think speaks a lot to the strength of our strategy. So I think that's going to wrap up the stream that we've got today. I'll try to download this and upload it to YouTube. Appreciate that. West Wind Winter. I appreciate how active you've been in the chat. We've got Tommy Lee dropping in. We'll keep this on long enough for his message to show up so he gets a little shout out here. But yeah, we're going to download this, upload it to YouTube in case you missed bits and pieces of it. And then we'll try to do this once a week every Sunday. And if there's anything going on during the week we want to address, we might hop back online. But help us out. Feel free to spread the word. And yeah, you did show up a little bit. You showed up a little bit too late. Sorry about that. But like I said, we are going to be downloading it. It's a 2-hour and 13-minute stream that we're wrapping up right now. So plenty of stuff that we're going to be throwing on onto YouTube for you guys to watch. So appreciate everyone who tuned in, and hopefully we'll see you guys again either later this week or sometimes next week. So sign off with the typical YouTube tab. Until next time, this has been the Hourglass Trader, where as time passes, we make money.